Hello and welcome to the first investment review of 2016, which I've issued in view of the quite peculiar behaviour of markets over the last few days. Given the very much announced news about the markets, I thought that this review would be timely and hopefully offer some reassurance. Market behaviour has been very volatile since the turn of the year, following on from a difficult summer and a difficult end to 2015. The reason for the fall seems to be the low price of oil and commodities. There is not any consensus on whether the markets are expensive, good value or cheap. At the moment, many analysts have different views for the short-term outlooks for markets. It seems sure, though, that they will be volatile. There has been a lot of speculation about the cost of oil, and it could even go to as low as $20 a barrel. It's currently $28. The $30 a barrel mark was seen as symbolic, and now this has been breached. The markets have started to fall quicker. The problem with oil is that there is a massive supply and non-increasing demand, especially now that the Iranians are back in the marketplace. An oil glut is associated with low demand, usage, so there is an assumption that this will lead to a global slowdown and less profits, thus lower stock markets. The problem with looking at markets and then trying to predict them is that they do not behave in a predictable manner. During the second half of 2015, the market was very volatile, and from a low point on the 24th of August to the close of business yesterday, the FTSE fell by 0.37%, but peaked during that period in October at 9.24% up. So in a 5-month period, a flat market fluctuated by over 9%, and any decisions to make changes in that period may have been beneficial or detrimental. So let's consider equity markets. These have obviously started the year on the back foot, with some market commentators publishing very bearish articles that have added to investor risk aversion. Whilst it is agreed that investment risk has increased, we do not feel compelled to move away from our more sanguine outlook for 2016. We expect the year to be difficult and volatile, but in the context of a medium-term investment, not in itself unusual, in what has become a more volatile arena. Since the turn of the year, two of China's policies have stoked negative investor sentiment, one of these being a series of consecutive interventions in the foreign exchange markets to weaken the renminbi, and the other a short-lived experiment in the use of circuit breakers designed to limit volatility in its stock market. Both have been interpreted as signs that China's authorities are worried that the country's economy is experiencing a deeper slowdown than they had originally expected. Alongside escalating tensions in the Middle East and further falls in commodity prices, most notably oil, these are the main factors that have driven the poor start for equities in 2016. There is thought that the market impact of the Chinese policies has been overdone, albeit it is difficult to measure this directly in light of other developments mentioned. Further devaluation of the renminbi has apparently been necessary for some time, and therefore this action does not come as a complete surprise. Furthermore, there is a belief that headline statements have exaggerated this development. The renminbi has only fallen by 1.25% against the US dollar so far this year. In regard to the experiment with circuit breakers, where markets stop trading if they fall sharply, this is seen as a characteristic of China's desire to hold a similar degree of control over its stock market as it does over its economy. Although the longer-term effect of this possibly clumsily undertaken policy is likely to be minimal, it is likely that similar efforts will be enacted in the future. Any such attempts may have similar short-term repercussions, such as periods of elevated market volatility. So, what of the central banks? It generally expected that there will be a gradual improvement in the global economic outlook over the course of 2016, with the central banks remaining accommodative and very cognizant of the fragility of the economic recovery. Certain central banks, the European Central Bank and Bank of Japan in particular, have the scope to increase monetary stimulus through their existing quantitative easing programs. So we need to think about our portfolios. On the next slide, which I've included to offer reassurance to our clients, I have charted the performance of a typical medium risk portfolio constructed by us and compared this to the very publicised FTSE 100. We don't celebrate downturns in value, but we can see here that our balanced view is helping to protect our position, and thus we should not react too negatively to the news surrounding only the FTSE 100 and perhaps other large international markets. Of course, we can never be completely insulated from these sort of market corrections, as we need exposure to equities inside the portfolios to eventually get some real growth. Our mix, though, sees us very much less affected by the current situation. Here is the chart covering a period from July last year up until yesterday. You can see here in the red line that our portfolio enjoys a very much more stable journey than the green line, which is the FTSE 100, and also it's notable that the loss has been far less severe. This is because of the balance of investments that we tend to hold. There is clear divergence in terms of economic growth and therefore monetary policy across the globe, and it's thought that this dynamic will persist for some time. As well as between economies, divergence has also been evident within economies. Some of the manufacturing, industrial and commodity-based sectors have lagged stronger service and consumer-orientated sectors. Improving employment prospects, wage growth and the benefits of a falling oil price may continue to benefit these latter areas of the market. Developed equity market valuations are not thought to be overly stretched, and we continue to focus our allocation into these markets to ensure that when normality returns we can gather some growth. Structural issues are prevailing in many Asian and emerging markets, particularly those exposed to the falling commodity dynamic, and these are likely to remain under pressure at least in the short term. In 2016, and while we remain vigilant of the risks, we feel that we need to be inside this environment, albeit occasionally unpalatable and worrying, as there are no other real methods for making returns within the correct level of balanced diversity. I've tried to keep this review succinct. There's an awful lot of noise out there in the markets at the moment. There is a general view that speculators are speculating on the market and thus driving it down, because these type of specialist investors often make money in falling markets. Our advice is to sit tight. We've undertaken long-term investment planning. We feel comfortable that the balanced shape of our portfolios is appropriate, and in general this can be seen in a medium risk chart which I showed earlier. There's little merit in having a knee-jerk reaction to the markets at present. History has shown us repeatedly that this kind of behaviour is often short-lived. We will obviously keep all of our clients abreast of any changes that take place in our views. Naturally, please do feel free to contact us if you require any further information. And as usual, our contact details are on the final next slide.